entity called Power Gilt Treasuries.
Actually, if you can speak here, it's much louder.
Of the financial assets portfolio of any individual or any corporate as such. Real estate, bullion, art, and amongst the financial assets, we have equities as well as these fixed deposits, bonds, government securities, etc. There happens to be a much more wider connotation and a greater dimension to the fixed income space than what generally we know about it. Maybe it's a lack of awareness or less familiarity with the various other products which are there in the fixed income space that they are not explored into. Normally in fixed deposit, in the fixed income space, we generally what we see is bank fixed deposits, then these monthly income plans, post office schemes. Apart from that, mutual funds have various liquid schemes, income and debt funds, and the fixed maturity plans. These, there happens to be another avenue of these financial instruments or debt instruments which are there, which are very attractive but which are unexplored. They happen to be these government securities, then corporate debentures, taxable bonds of public sector undertakings, and various tax-free bonds and zero coupon bonds. If we invest in, say, these schemes of mutual funds, the income funds or the debt funds, they in turn actually land up investing in these bonds and securities in commercial papers. But that is a via media route, or we are going through an intermediary. Over here, if there is an opportunity to invest in these fixed income instruments directly, and the returns which are promised or which you obtain is quite high and reasonably would beat inflation. If you simply invest in a bank fixed deposit, you end up earning, say for example, 8 to 9% interest, but the inflation eats up a substantial part of the earning you make. Whereas if you go through, say, an income fund or you invest in these bonds, the actual return which you realize is far higher than the normal return which the bank is going to pay you. To some extent, you're covered by the inflation, and apart from that, you make a certain degree of capital appreciation also, which is missing in these plain vanilla fixed deposits. Now, fixed income, coming back to the managing of fixed income portfolio, it is need-based, and each and every investor class, be it a corporate, be it an individual investor, or a charitable trust or a provident fund trust, they have specific investment needs. For example, for an individual, a person who's a retired or a pensioner, he needs a regular periodic flow of income every month or every year at a particular point of time. That need is taken care of by various instruments where you can get a fixed amount at a determined period of time. Secondly, this need for savings, that is being addressed to by various bonds and securities. Third need is the parking of funds. Say a corporate has idle money now, or an individual has idle money now. He might not be having specific need to use that money. He wants to store that money for, say, 1 month, 2 months, 10 days, 5 days or so. So this parking of funds and plus earning some interest out of it, that is being addressed to by, say, various fixed income instruments. Thirdly, there might be a financial goal which an individual or a corporate might be having. You might be needing specific amount of funds for your children's education or marriage at, say, a particular point of time. There are products available where you leverage on the power of compounding to get a desired amount of money at a particular point of time. Say after 5 years or 10 years, you want X amount of money, you invest in certain fixed income instruments wherein that need can be fulfilled. And the last one happens to be capturing arbitrage opportunities. People who trade in these fixed income instruments, they can generate higher income, or they generate arbitrage returns. Say, I'll give you a small example. If you borrow money at 9% and you invest in a fixed income instrument which gives you 10%, you make 1% profit. That is the most simplest form of arbitrage. Secondly, you can do cross-country arbitrages also. Say in United States, the interest rate is probably, the LIBOR is 0.25%. You can get money over there. You can borrow money at around 2%. You get that money into India, convert it into INR. Even if you deposit that money in a bank fixed deposit, you're earning anywhere between 9%. So there's a 7% float. You have to manage the forex risk, and then after that also you end up earning 2%. So that is an arbitrage opportunity which can be earned if like various strategies are devised, and these financial instruments in the fixed income form, they can be used. One more aspect is the capital appreciation, what you get through investing in bonds and in income funds. We happen to be in the declining interest rate scenario. Reserve Bank of India has taken gradual steps to lower the interest rates. Our economy also happens to be in shambles. The GDP growth rate happens to be at the lowest ebb. IIP figures are also negative. Now, Reserve Bank of India is taking steps, A, to increase liquidity and to spur the GDP growth. Lowering of interest rate is one of the key aspects here. If interest rates are gradually subsiding down, if they come down, and then the bond prices, they go up. Effective yield, what you get with the lowering of interest rates, happen to be much higher than what you get in by investing in normal fixed deposits and all. In the past, we have got returns to the tune of 16 to 18%, which is far higher than any of these plain vanilla debt instruments can give it to you. And that is precisely because interest rates in the market have gone down, but the instrument which you hold still gives a higher rate of return and is going to continue to give it till, say, X amount of time. To which the bond is going to mature. Say if you hold a 10-year bond which gives you 10% interest, and in the market eventually the interest rates fall, the price of that bond comes, like the price rises, and you reap supernormal returns. So this was basically, like, I gave you a brief idea of what fixed income portfolio management, how various needs of yours can be addressed, and how you can earn a higher return through systematically investing in them. Thank you.
Thank you very much, Mr. Nahata. Can I call upon Mr. Gaurang Ganeriwal to talk about the most difficult of the issues?
Good afternoon, everyone, and thanks Rotary for inviting me for such a panel. If we talk about views or news, we always hear about volatility. That's been there, a part of our system since the past 3 years, and that looks to be hounding us for some little more time, because obviously there are reasons for this volatility, and that is there with our system today. And that could be predominantly because of a lot of reasons, because of maybe twin deficits being very high, maybe because of political uncertainty, or maybe uncertainties in the global markets. So there could be various reasons where we can say that yes, the volatility is there to stay, or has been with us since the past 3 to 4 to 5 years. If we break up the past 10 years into different phases, like if we take up a period of from 2002 to 2008, we've seen a very secular run. You put in money anywhere, your money grows. You put in money in any stock, the stocks grows. You put in money in any mutual funds, the mutual funds grows. Like for example, an interesting data which suggests that the best mutual fund schemes delivered a return of 70% during that period of time. The worst delivered a 20%, and an average made a 40%. So any MF schemes that you pick up would make you a 20% kind of a return. But in the past 5 years, the things have been very different, where the volatility has been there and the markets have been trading in a very range-bound session. The markets, maybe in the past 3 months only, we saw the data that has come down from 18 to it's gone up from 1600 levels to an 18200 kind of level. So the markets has been quite a volatile in the past sessions. So how do we address this problem of volatility? So what we have done, I mean, we as a fund house, from ICICI Prudential Mutual Funds, we have created a bouquet of products which can cater only to these volatile kind of trading sessions and try and generate returns out of here. I mean, volatility is taken to be a very negative kind of a term, where people try to shy away from volatility because they think the returns can't be generated in these kind of volatile sessions. But that's not the case. If I take the last 3 years return on the Nifty has maybe delivered just a 1.4% kind of a return. But trading on these volatile kind of funds, I mean, we have generated a return of close to 8.5% also on the CAGR basis on a 3-year basis. So volatility is going to stay there. What, as a fund house, we can do is, we have created products which are trading from 0 to 100% of equity, and they take a calibrated measure and calibrate themselves depending on the market conditions, whereby they are buying low and selling high. So that is how we can ride on the volatility, and I would urge our investors not to shy away from volatility, but to take a part in the volatile sessions and make returns for themselves. Thanks a lot.
Thank you. May I invite Sri Priya Santakumari to talk about investor protection from the stock exchange.